For the last decade, the market operated on a specific belief: the future belongs entirely to software. Investors assumed that frictionless code and artificial intelligence would drive all future economic growth. But the physical economy is sending hidden warnings. Even as software scales, the prices for essential physical goods and services are remaining stubbornly high. This decade favored the asset-light model. Capital flowed towards software and algorithms, moving attention away from the heavy physical infrastructure that underpins the real world. Now, those neglected physical assets are starting to dictate the terms of global growth. This is the revenge of the old economy. Every digital revolution eventually hits a physical wall. If we ignore the real-world constraints of materials and energy, the digital boom becomes unsustainable. This chart shows a widening gap between raw crude oil and finished fuels like diesel and jet fuel. This profit margin, the crack spread, has stretched to historic highs. A raw crude surplus doesn't help if you lack the industrial machinery to process it. A geopolitical catalyst triggered this bottleneck. Targeted drone strikes reached deep inside Russia and destroyed critical crude oil distillation units, the primary towers of a refinery. This lost refining capacity will take years of labor and steel to rebuild, effectively trapping global oil supplies where they can't be used. Finding more oil won't solve this crisis. We are missing the physical industrial capacity required to turn that oil into fuel. The AI boom faces the same physical reality. Advanced computing requires an immense physical footprint: thousands of data centers, heavy-duty transformers, and turbines. While tech investment sits at record highs, global capital expenditure in metals and mining has collapsed by 35%. The projected copper demand to build the AI power grid sits well above the current trajectory of mining investments. The copper and raw metals required to build out this digital infrastructure simply are not being pulled out of the ground at the scale we need. Every new AI model requires a corresponding increase in physical extraction. Without a massive acceleration in mining, the revolution hits a hard physical limit. At the same time, we are moving into a multipolar world. Nations can no longer rely on frictionless global trade to fill the gaps. Global inventory buffers are exhausted. Constant disruptions and major shipping straits have ended the era of efficient, just-in-time logistics. Now, the US and Europe must rebuild localized, asset-heavy supply chains, pouring capital back into manufacturing and national defense to ensure their own security. The shift away from global efficiency is a structural guarantee of higher commodity and manufacturing prices for years to come. To solve these shortages, we are seeing a great capital rotation. Commodity prices must rise high enough to attract investment dollars back into the physical sectors we neglected for a decade. Market power is shifting toward the new bottlenecks: the owners of real estate, energy grids, and heavy industrials. Corporations are already adapting to these higher physical costs by changing how they sell to the consumer. Look at network airlines. To offset the spiking costs of refined jet fuel, they are aggressively expanding premium cabins, focusing their business on travelers who can pay the highest margins. When the baseline cost of energy and materials rises, companies prioritize the top end of the market to maintain their profits. This creates a permanent split: premium services for the wealthy and a shrinking middle ground for everyone else. The winners of the next decade won't be the companies with the smartest code. They will be the companies that control the concrete, the copper, and the energy required to keep the servers turned on.